Good day, everyone. I'm Michael Chang, Chief Investment Officer Fixed Income at RHB Asset Management. Thank you once again for listening to this podcast. For the last couple of months, the Delta variant has left many ASEAN economies to revise growth rates lower as it forces ASEAN to reimpose pandemic restrictions. Malaysia's growth outlook for this year was downgraded the most, a swing of 1.4 percentage points to a 4.3% expansion, according to the latest economist survey results compiled by Bloomberg. Thailand downgraded to 1.2% from 2.4%, albeit still expected to post the slowest growth within ASEAN. Singapore is the only country in the region to buck the downgrade trend, where it was forecasted to grow 6.5% compared to a previous estimate of 6.3%. The rapid spread of the highly infectious Delta variant and low vaccination rates have caught much of Southeast Asia off guard. Recall back in June 2021, when I talked about diving deeper to the topic of global inflation based on a research dashboard by John Orders, which was featured in Bloomberg. We will spend some time to talk about the September's dashboard and how it has changed since June. As expected and hoped, August saw a downtick for inflation on both core and on headline basis. Beyond the official data, this latest update of Bloomberg's inflation indicators shows a steady but still not intense broadening of inflationary pressures. Diving deeper to the details by official measures, June's inflation data delivered a third nasty shock in succession, but in July, headline inflation stopped the streak. Headline then stayed unchanged, more or less exactly in line with expectation in August. The bond market, where traders make their most precise predictions of inflation, appears not to be worried about inflation. After a brief scare earlier in the year, the current US 5-year break-even topped 2.75 previously, but is now hovering at 2.5% for several months now and does not suggest runaway inflation. Meanwhile, expectations for the year from 2026 to 2031 stand at 2.2%, so there's still confidence that the Fed will rein in inflation over the next 5 years. Nobody is positioned for the Fed to lose control of inflation anytime soon. Broadly, the consensus is that Fed, like other central banks, will get what it wants. Among economists judged collectively, this belief has been unwavering for months. The Fed is forecasting core PCE of 3% for this year, but expects it to decline to 2% in 2023. In other words, it will be transitory. The experts are less anxious for now and think it will reach 2.5% this year and decline in the 2 following years, more or less perfect for the Fed. Domestically, Malaysia's inflation picked up sharply to 4.7% year-on-year in April, but that was the peak after successive moderations in May, June, and July readings. The increase in Q2 tracked the return to 2019 levels in oil prices after last year's slump from the pandemic. As energy prices plunged last year, so did Malaysia's inflation, which was negative between March 2020 and January 2021. Malaysia's inflation is likely to soften further in August, followed by stabilization below 2% anticipated for Q4. Core inflation has held in the 0.7% to 0.8% range since October 2020. Due to ongoing spare capacity, Bank Negara Malaysia expects underlying inflation to remain subdued for the rest of the year. On 9 September 2021, Bank Negara Malaysia has left the OPR unchanged at 1.75. Bank Negara reiterated that global growth outlook is tilted to the downside, as it is mainly attributed by uncertainty over the path of pandemic posed by the Delta variant. That said, optimistically, Malaysia's growth is set to pick up again via easing of containment measures and likely to gather momentum going into 2022. In terms of domestic bond market, rising US and MGS 10-year yields over the past months have made the spread attractive again, which is now hovering around 200 basis points. In June, it was at 180 basis points at a time where there were more domestic-related uncertainties compared to now. With Malaysia's GDP being revised lower from the start of the year and inflation set to moderate lower, there are values in the MGS space should yields continue to creep higher, as the OPR is set to remain steady in the medium term to support the catch-up in domestic economic growth. We hope this podcast has been useful to you, and thank you for listening.